The next key area that I'm going to be discussing right now, that would be financial ratios. So again, for today, we want to restate the accounting data in relative terms, or what we call as financial ratios. So what is meant by financial ratios then? If we say financial ratios, it helps us identify some of the financial strengths and weaknesses of a certain company. Now, the ratios give us two ways of making meaningful comparisons of a firm's financial data. First, we can examine the ratios across time, say for the last 5 years, to identify any trends. And second, we can compare the firm's ratios with those of other firms. Mathematically, a financial ratio is nothing more than a ratio whose numerator and denominator are comprised of financial data. Sounds simple, right? Well, in concept, it is. The objective in using a ratio when analyzing a financial information is to simply standardize the information being analyzed so that comparisons can be made between ratios of different firms or possibly the same firm at different points in time. Now, we need to try to keep this in mind as we go through the discussion of financial ratios. All we are doing is just we are trying to standardize financial data, and so we can make comparisons with industry norms or other standards. Now, in comparing our firm with other companies, we could select a peer group of companies, or we could use industry norms published by firms such as Dun and Bradstreet, Robert Morris Associates, Standard and Poor's, and Prentice Hall. Dun and Bradstreet, for instance, annually publishes a set of 14 key ratios for each of 125 lines of business. Robert Morris Associates, the Association of Bank Loan and Credit Officers, publishes a set of 16 key ratios for more than 350 lines of business. In both cases, the ratios are classified by industry and by firm size to provide the basis for more meaningful comparisons. Now, in learning about ratios, we could simply study the different types or categories of ratios, or we could use ratios to answer some important questions about a firm's operation. And we prefer the latter approach and have chosen the following 4 questions as a map in using financial ratios. The first question that will serve as a map in using financial ratios, that would be, how liquid is the firm? The liquidity of a business is defined as its ability to meet maturing debt obligations. That is, does or will the firm have the resources to pay the creditors when the debt comes due? Now, there are 2 ways to approach the liquidity question. First, we can look at the firm's assets that are relatively liquid in nature and compare them with the amount of debt coming due in the near term. And second, we can look at how quickly the firm's liquid assets are being converted into cash. And the second question that will serve as a map in using financial ratios, that would be, is management generating adequate operating profits on the firm's assets? Now, in here, we now begin a different line of thinking that will carry us through all the remaining questions. And at this point, we want to know if the profits are sufficient relative to the assets being invested. The question is similar to a question one might ask about the interest being earned on a savings account at the bank. When you invest $1,000 in a savings account and receive $40 in interest during the year, you are earning a 4% return on your investment. Now, with respect to let's say McDonald's Corporation or Jollibee Foods Corporation, we want to know something similar. The rate of return management is earning on the firm's assets. Now, in answering this question, we have several choices about how we measure profits. It's either gross profits, operating profits, or net income. If we say gross profits, this would not be an acceptable choice because it does not include some important information, such as the cost of marketing and distributing the firm's product. Therefore, we should choose between operating profits and net income. For our purposes, we prefer to use operating profits. Why? Because this measure of firm's profits is calculated before the costs of the company's financing policies have been deducted. And because financing is explicitly considered in our next question, we want to isolate only the operating aspects of the company's profits at this point. And in this way, we are able to compare the profitability of firms with different debt to equity mixes. And therefore, to examine the level of operating profits relative to assets, we would use the operating income return on investments. But don't you worry, we will be discussing these types of ratios in the proceeding section. And the next question that will serve as a map in using financial ratios, that would be, how is the firm financing its assets? Now, we now turn to the matter of how the firm is being financed, or we shall return to the firm's profitability shortly. Now, the basic issue is the use of debt versus equity. Do we finance the assets more by debt or equity? Now, we use the term debt and liabilities interchangeably, okay? Remember that. And in answering this question, we use two ratios. First, we simply ask what percentage of the firm's assets are financed by debt, including both short-term and long-term debt, realizing the remaining percentage must be financed by equity. And our second perspective regarding the firm's financing decisions comes by looking at the income statement. When we borrow money, there is a minimum requirement that the firm pay the interest on the debt, right? Therefore, it is informative to compare the amount of operating income that is available to service the interest with the amount of interest that is to be paid. Stated as a ratio, we compute the number of times we are earning our interest, and therefore, a times interest earned ratio is commonly used when examining the firm's debt position. And the last question that will serve as a map in using financial ratios, that would be, is management providing a good return on the capital provided by the shareholders? Now, our one remaining question looks at the accounting return on the common stockholders' investment, or return on common equity. That is, we want to know if the earnings available to the firm's owners or common equity investors are attractive when compared with the returns of owners of companies in the peer group. Now, in order for us to better understand these ratios, let us move on by discussing individually the different types of financial ratios. Now, as you can see, we have 5 types of financial ratios. First, we have liquidity ratios. Second, we have asset turnover ratios. Third, we have financial leverage ratios. Fourth, we have profitability ratios. And lastly, we have dividend policy ratios. Now, in this case, we will discuss first liquidity ratios. And under liquidity ratios, it has two types. First, we have current ratios, and second, we have acidity ratios, or also known as quick ratios. Now, if we say current ratios, it is a liquidity ratio that measures a company's ability to pay short-term and long-term obligations. And the formula that we will be using in computing current ratios, that would be current assets divided by current liabilities. And the next type of liquidity ratio, that would be acid test ratios, or also known as quick ratios. If we say quick ratios, these are a strong indicator of whether a firm has sufficient short-term assets to cover its immediate liabilities. And the formula that we will be using in calculating acid test ratios or quick ratios, that would be current assets minus inventories all over current liabilities. Now, in order for us to better understand the difference between acid test ratio and current ratio, let me show you an example. So as you can see on the tabulation, so we are comparing two companies. First, we have the McDonald's Corporation, and second, we will be comparing McDonald's to the peer group. Now, in current ratio, as you can see, McDonald has 0.70 current ratio. Same with the peer group, which has 0.70 current ratio. On the other hand, under acid test ratio, McDonald's Corporation has 0.66 compared to peer group, which has 0.40. So what is meant by this? What is its implication then? Now, let's have first current ratio. Now, in terms of current ratio, McDonald's has the same liquidity as the average firm in the peer group, which is $0.70 or 70 cents in current assets for every $1 in short-term debt. On the other hand, under acid test ratio or quick ratio, however, McDonald's appeared to have more liquidity when we use the acid test ratio to measure liquidity. It has $0.66 or 66 cents in current assets, less inventories relative to current liabilities, compared to $0.40 or 40 cents for the average company. Now, given the conventional wisdom that firms should maintain about $2 in current assets for every $1 in current debt, an idea that fails to recognize the unique needs of various companies. McDonald's and the selected peer groups are less liquid than most other companies. Now, what will happen if you have less current assets in every $1 current liability, okay? So what will happen if you have less than $1 current assets versus $1 current debt? Now, if you have less assets, okay, or less than $1 assets for every $1 current debt, chances are your firm or your company will not be able to pay off your loan or will be having a hard time paying your maturing debt obligation because, again, like I said earlier, it's already a conventional wisdom that firms should maintain about $2 in current assets for every $1 in current debt. Okay, next we have another type of ratio. We have what we call asset turnover ratios, and it has three types. First, we have receivables turnover. Second, we have average collection period. And third, we have inventory turnover. Now, in order for us to better understand each of these types, let me discuss to you receivables turnover first. Now, if we see receivables turnover ratios, it is an accounting measure used to quantify a company's effectiveness in collecting its receivables or money owed by its customers. And the formula that we will be using in calculating receivables turnover ratios, that would be net credit sales all over average accounts receivable. Now, this is best understood by showing you an example. So for example, let's say company A had the following financial results for the year. The net credit sales of $800,000 and $64,000 in accounts receivables on January 1st, or the beginning of the year. And we also have $72,000 in accounts receivables on December 31st, or at the end of the year. Now remember, in calculating the receivable turnover ratio, our formula should be net credit sales all over the average accounts receivable. Now, we cannot compute yet our receivable turnover ratio if we don't have the value of our average accounts receivable as of yet. So therefore, the very first thing that we need to do is to get the average or the mean of our accounts receivable. So simply, we will add our accounts receivable beginning, which is $64,000, and our accounts receivable ending, which is $72,000. So the mean would be $68,000. Now, having this value, we are now able to calculate our receivable turnover ratio. So our receivable turnover ratio, that would be our net credit sales, is equal to $800,000 all over our average accounts receivable of $68,000, and therefore our receivable turnover ratio is 11.76. So what does it mean? Now, we can interpret the ratio to mean that company A collected its receivables 11.76 times on average that year. In other words, the company converted its receivables to cash 11.76 times that year. And a company could compare several years to ascertain whether 11.76 is an improvement or an indication of a slower collection process. A company could also determine the average duration of accounts receivable, or the number of days it takes to collect them during the year. Now, in our example, on the previous page, we would divide the ratio of 11.76 by 365 days to arrive at the average duration. Now, the average accounts receivable turnover in days would be 31.04 days. Now, for company A, customers on average take 31 days to pay their receivables. Supposing if the company had a 30-day payment policy for its customers, the average accounts receivable turnover shows that on average, customers are paying 1 day late, right? Because their late charge policy is only 30 days. It's 30-day period. Beyond 30 days, you will already be charged with a late charge fee, just in case a company implements that policy whenever their customers would pay their accounts beyond their due date, right? So therefore, it's very clear that customers are paying 1 day late. Now, a company could improve its turnover ratio by making changes to its collection process. So how do we do that? A company could also offer its customers discounts for paying early, okay? It's very effective, and in fact, it's important for companies to know the receivables turnover, since it's directly tied to how much cash they'll available to pay their short-term liabilities, okay? So the next type of asset turnover ratio, that would be average collection period. If we say average collection period, It is the conversion of accounts receivable into cash can be measured by computing how long it takes to collect the firm's receivable. And the formula, as you can see, the formula that we will be using in calculating average collection period, that would be accounts receivable all over daily credit sales. Now, this is best understood by providing an example. So here's our example. Now, assuming that McDonald's Corporation sales of $14,244,000,000 in 2000 to be credit sales as opposed to some cash sales with a total accounts receivable of $797 million, then the firm's average collection period is, okay, by using our formula, so that would be accounts receivable. So our accounts receivable would be $797 million divided by our daily credit sales of $14,244,000,000 all over 365 days, because since it's daily, so we need to convert it into days. And remember, there are 365 days in a year. So therefore, our average collection period is 20.4 days with respect to McDonald's Corporation, compared to peer group, which has 6.5 days. So what is meant by this? 20.4 days for McDonald's, and the peer group is 6.5 days. Now, therefore, McDonald's Corporation does not collect its receivables as quickly as average firm in the comparison group, because 20.4 days compared with 6.5 days for the industry. So therefore, comparing the two, the peer group is quicker compared to McDonald's in terms of collecting its receivables. Okay, so the next type of asset turnover, that would be inventory turnover. If we say inventory turnover, it is a ratio showing how many times a company has sold and replaced inventory during a given period. Now, we have two options in calculating inventory turnover ratio. First, we have cost of goods sold all over inventory, or we can also use sales all over average inventory. Now, in order for us to better understand inventory turnover, let us have an example. For example, assuming that McDonald's Corporation's cost of goods sold was $8,622,000,000 and its inventory was $99 million, therefore, the firm's inventory turnover along with the peer group are as follows. So, using our formula, we have cost of goods sold all over inventory. So, dividing the two, we get an inventory turnover of 87 times per year, compared to the peer group of 35 times per year only. So what is meant by this? Who is more effective in terms of inventory turnover? Now, given these results, we can conclude that McDonald's is clearly excellent in inventory management, turning its inventory over 87 times per year compared with 35 times for the industry. In other words, McDonald's sells its inventory in 4 days on average, which is computed as 365 days in a year divided by 87 times, whereas the average firm takes 10 days only. Okay, so moving on to the next type of financial ratio, we have financial leverage ratios. And financial leverage ratio is composed of two types. First, we have debt ratio, and second, we have times interest earned. Now, let me discuss to you first what a debt ratio is. Now, if we say debt ratio, it is the ratio of total debt to total assets expressed as a decimal or percentage. It can be interpreted as the proportion of a company's assets that are financed by debt. And the formula in getting debt ratio, that would be our total debt or total liability all over our total assets. Now, in order for us to better understand debt ratio, let us have a specific example. So as an example, McDonald's Corporation listed $7,846,400,000 in short-term and current portion of long-term debt on its balance sheet for the fiscal year ended October 1st, 2020, and $3,932,600 in long-term debt. The company's total assets were $21,684,000,000. Remember that in getting the debt ratio, we need to have our total debt divided to total assets. Now remember, based on our problem, we have identified a long-term debt of $7,846,400,000, and we also have another short-term debt, which is amounting to $3,932,600,000. So the first thing that we need to do is to add first our short-term and long-term debt, because remember, we are getting the total debt or total liability. So it will be divided by our total assets of $21,684,000,000. And the result of McDonald's Corporation's debt ratio, that would be 54% compared to peer group of 69%. Now, what is meant by this? Now, therefore, McDonald's Corporation uses significantly less debt in financing its assets than the average firm in the industry. So, meaning to say, this is advantageous to the part of the McDonald's Corporation. Okay, next type of financial leverage ratio, we have times interest earned. If we say times interest earned, it is a measure of a company's ability to meet its debt obligations based on its current income. And the formula for our times interest earned, that would be operating income all over interest. And in order for us to better understand this, let me show you an example. So supposing McDonald's Corporation listed $3,329,000,000 in operating income in 2020 with an interest of $446 million. Now, all we need to do is to plug in the values to our formula. So our formula, that would be operating income amounting to $3,329,000,000 all over our interest of $446 million. And therefore, the result would be 7.46 for our times interest earned based on McDonald's Corporation, compared to the peer group, which has 3.3. So what is meant by this now? Now, therefore, McDonald's Corporation is able to service its interest expense without any great difficulty. And in fact, the firm's operating income could fall to as little as 1/7, okay, its current level, and still have the income to pay the required interest. The next type of financial ratio, that would be profitability ratios. And for profitability ratio and the remaining one type of financial ratio, We will be discussing its examples on our next video. But in this case, I will just have to give you an idea about the different types of profitability ratios. Now, under profitability ratios, this is composed of three types. First, we have gross profit margin. Second, we have return on assets. And lastly, we have return on equity. And what is meant then by gross profit margin? If we say gross profit margin, it is the measure of gross profit earned on sales. And the formula in getting our gross profit margin, that would be sales minus cost of goods sold all over sales. On the other hand, we have return on assets. And if we say return on assets, it is a measure of how effectively the firm's assets are being used to generate profits. And the formula in getting return on assets, that would be our net income all over our total assets. And finally, we have return on equity. And if we say return on equity, it is the bottom line in measure for the shareholder profits earned for each peso or dollar invested in the firm's stock. And the formula in getting return on equity, that would be net income all over shareholders' equity. Again, on our next video, we will be discussing some examples under profitability ratios. So you need to take a look at that one. And finally, the last type of financial ratio that we have, that would be dividend policy ratios. And dividend policy ratios is composed of two types. First, we have dividend yield, and second, we have payout ratio. And for dividend yield formula, we have dividends per share all over share price. Again, just a brief recap. If we say dividend, this is a portion of profit after tax that is given out to shareholders or stockholders. Again, our formula in getting dividend yield, that would be dividends per share all over the share price. And finally, we have payout ratio. And in getting payout ratio, we have dividends per share all over earnings per share. All right, I think that's a good place to stop. If you have questions, please let me know on the comment section below. And if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.